Hello. In this video, I would like to take the time and return to a very basic and simple, yet one of the most powerful concepts in trading. I've been getting quite a lot of questions recently from you fellow traders in how I define key levels and how I'm able to sculpt the smaller time frames. And I would like to sharpen my own thoughts with this video by explaining what Daniel has taught us and reasoning my way of how I've been using it up till now. It has recently been a very profitable way of trading for me, and by recording this video, I'm hoping that maybe it can not only benefit myself as I reason my way through these slides, but also some others in the group. I think it can also be useful, always be useful to take a step back and return to the very basics, as I believe getting the fundamentals right is really one of the hardest things to do, even though they're seemingly simple in theory, as with every craft and also in trading. I hope you'll enjoy, and yeah, I look forward to hearing your thoughts. So, market structure is, for me, very important in the sense that I believe many of the tools that we use daily in the group, in technical analysis in general, such as Fibonacci, Elliott waves, harmonics, I think they all stem from the identification of market structure as an underlying base. Most importantly, I think if you're able to read market structure correctly, you can identify a trend on any given time frame, which in turn can help you build a case for a potential trade, whether that's bullish or bearish. Once you're able to read market structure correctly, then you can also identify when a trend has ended and is about to reverse. Although entering a trade purely based on a change in market structure might be a little bit difficult, because those zones can be very wide, especially when you're swing trading on a higher term time frame. So it's wise to find more forms of confluence before entering a trade to determine basically a more exact entry and invalidation point. Well, with that said, when it comes to trends or determining what direction the market is currently developing in, I think you can subdivide the market in three big categories, or three basic directions, which is upwards movement, downwards movements, and sideways movements. So when trying to define an uptrend, let's say this is all the data you've got. We basically here have a low point in price and a high point in price, as you can see here, low and a high. Price always goes up and down, as that's the nature of price movement and markets in general. So based off that, we can use what happened previously to build a good argument of what potentially can happen next. So whenever the price breaches the previous high point of the price, making essentially a higher high, and then in turn does not breach below the low point in price here, and then instead makes another higher high, then you have a solid argument, and then you can conclude that the price has established an uptrend. And then that basically means that a continuation of this trend is likely, and that's when I would personally look for a long. The same thing is with a downtrend, but then in reverse. So if you have a high and then you have a low point, and then price returns but does not reach the previous high, and then turns down, back down again, you've created a lower high. And then on the point that it breaches the lower low again, you are making a lower low. And then when it comes back up again, making another lower high and a lower low, then you basically have a downtrend. Technically speaking, the downtrend starts here, and the fact that price here is not able to make a higher high or breach this point or this point, it means that the trend is continuing. And for example, if you are already in a short, there's no reason to close your trade. The other movement is a sideways movement. So when you do make a higher high and a higher low, and then in turn make a higher high, basically you could say that okay, from here on we've made a we are in an uptrend. But as time and price progresses, price comes back and then, for example, does not go below the low. The trend is not lost. But then in turn, when price moves back up again, it also doesn't breach the higher high. Then the price goes sideways. The result is basically what it means is that there's indecision in the price, and we're now forming a sideways range in price. And there's two ways how you can trade it. You can trade inside the range, so you can establish this as a low and a high and trade within that, or you can trade the breakout, and that can be either to the upside or the downside. So those are the three directions in the market. And let's say we have an established downtrend. With that knowledge, you can now also try to determine when a trend change is about to occur. So let's say we have a high, and then we have a low, and we make a lower high and then a lower low. We're basically in a downtrend. But then on the moment that the high point is being breached, essentially creating a higher high, then you could say that okay, the high point in price is now broken. And to confirm that, what you would typically be looking for is a higher low, because that helps. And then in turn, when the higher high is being printed again, then basically what you can say is the same as in this slide, an uptrend is being confirmed. So on the point that you have your low, and then whenever that high is being breached again, just for clarity's sake, and then creating a higher low and then breaching that higher high again, you could say that the downtrend has now ended and has transitioned into an uptrend. And that would make make a good case to start looking for a long. This is a little bit of a more complex examples, because in reality, price often looks more like this. It rarely happens that you just have a lower high, lower low, and then immediately changes to an uptrend. It does happen from time to time, especially on the lower time frames. But what more often happens in price is when you have basically a downtrend. So you have a high and a low, and you're making lower highs, lower lows, lower highs, lower lows. You're having a downwards trend. And more often, it happens quite a lot that upon breaking this trend line, basically breaching this lower high, you could say that okay, now the trend has been broken. It does make a higher low, and further on it makes a higher high. You could say that this is a trend change. However, because the trend didn't start there, the downtrend started here. So upon breaching this trend line is not necessarily a confirmation of a trend line of a trend being changed. How I personally would see it, and of course, when I'm scalping, I do trade this. But let's say this is a swing trade, and let's say this is on a 4-hour time frame or higher. I would not necessarily be looking for long upon breaching this break of price, because it might as well, as long as the bigger trend is not broken, it might as well just turn south here, and then you would be in a losing position. So how I would see this is rather an early indication of a potential trend change. And then on the moment that it actually breaches the high of where the trend has started, essentially printing a higher high, that's when I would really look for a higher low. And then upon confirmation, that's when I, for myself, I would say, okay, now the trend has been changed, and this is where I would start looking for a long. So when you reason on about the fact that in order for a trend change to occur, old highs or old lows have to be breached in order for a trend change to occur, it does make sense to pull horizontal lines from older highs and lows. Where price previously could not breach an older high, it means that there's basically no interest to buy. As a result, price falls down again, and the old high, which is here, acts as resistance that essentially maintains the current trend. Once it does break through, it is very common for price to also return back to the old high to see if there's buying interest instead of selling interest now. And if there's now interest to buy, then that gives the perfect ingredient for price to continue higher. And the old high resistance line has now flipped in support. So what I'm trying to get at is that basically market structure is where these basic concepts stem from. So based off of market structure, you can try to determine, okay, where's the demand and where's the supply? Essentially establishing horizontal support and resistance lines. The higher time frames, basically, you are able to identify these resistance and support lines, the stronger they tend to be. Within the group and according to Daniel's teachings, we take those support and resistance lines from the closes and call them out similar to the time frames we are working on, monthlies, dailies, and weeklies, and so on and so on. Price does have wicks, but horizontal resistances is we generally take that from the closes, and the wicks we tend to pull those Fibonacci lines from them. In that way, it gives kind of like a nice mixture of the closes of the candles and the wicks of the candles, basically encompassing the entire zone of price action in total. What I would like to show now is a trade that has been a really successful trade for me. And I would kind of like to walk through how I approached that and how I did my technical analysis on the spot back then. This is a little bit back in time, so this is in hindsight, but basically what I'm doing, I'm recreating the situation of how I took that particular trade. The reason why I'm picking this particular moment in price is because this has been one of my most profitable trades ever since I started trading. So I thought this is a good example, and I used these market structure very heavily to determine whether I should enter a long or not. So this is taken on the 3rd of January. I took this trade, I believe, somewhere. So basically, we're looking here at some price action. We had some downwards movement, and we've basically put in a low. So the first thing that I would do, we're on the 5-minute time frame, and this is also the time frame that I actually took the trade on. So the first thing that I would do is I would put a horizontal support and resistance line, because the new low is in, from the close of the candle. I would mark it as a key level. It's a template that I have set on TradingView, so I can do it really quickly, which is important for me, especially when scalping on smaller time frames. It's very important to work very fast and do analysis extremely quickly. So if necessary, I can enter into a trade very quick. So we have put in a low. Essentially, what you could say is, okay, here we have done, we've printed a higher high, and here a higher low, and here a higher high, and a higher low, and a higher high. Essentially, you could say, yes, we are in a small 5-minute uptrend here. I don't trade solely, like I said in the beginning, I don't trade solely based off market structure and these horizontal lines. I look at other things. I look at things like order block, how does the volume look like, where are we in the Elliott wave count. So many I factor in many different things, open interest, these kind of things. But for the sake of this video, I really want to focus purely on the market structure side of things. We were here at a very pivotal point in price on a bigger, more global Fibonacci number. So this is where I was also looking for a trend change. I was already looking for it. But as I was marking it out, so I didn't take the trade here because I thought that this was not the high or the low maybe yet. So what I did, I was just monitoring it. So we've printed here now a high. So what I would look for now is it's basically now between these two key levels. If price breaches now through this key level or retraces properly, for my feeling, this was not enough yet. And how I do that is then I pull a Fibonacci line from the wick, and this way you encompass the complete price action. So from the close of the wicks, from the close of the candles, apologies, and from the wicks of the candles. So I'm able to monitor the entire price sequence. The 618, which is called the Champions Channel, is a very significant one, especially in cryptocurrency. So this is usually what I try to monitor. And so I would have this on and I would wait. And what we can see is it's now really between those two levels. And if I now move a little bit forward in price, we can see that the price is literally ranging between these two key levels. And as you can see, I'm quite happy that I didn't took this trade because it seems we've never breached the high. So if I would have entered into a long here, I would now be pretty far underwater, because we've now printed a new low. Whenever that happens, what I then tend to do is, so basically this line of support has now potentially flipped into resistance. But for simplicity's sake, what I would do now is I would move this key level onto the new low. And essentially the range has now widened. So what I would do now, so I would start over the whole process. So we've now put on a higher low. So what I would be looking for now is to make higher high, higher low, higher high, higher low, until we breach this level. That would mean basically we are breaking outside of the range. So that's what I would be looking for now. Typically I would pull also Fibonacci's from top to bottom again to see if there's any significant support and resistance flip about to happen. I would typically set an alarm somewhere around here and just see what price is doing, because if we would breach this, then it is likely that we're about to come on top of this this range and potentially breach it. So that's why I would have on this Fibonacci level for now, and then I would repeat the same process. I would also start pulling fibs from low to high and basically follow what price is doing. So let's say this is a bit too far, but what I would do, I would track the Fibonacci level all the time and have them all on, by the way, especially if price is rising and if you don't really know if a top is in. I just track the levels on and on and on and on. Here it seems like we've topped out momentarily, flipping the 618 actually. But let's say I didn't have that one on. So what I would now register is price is now bouncing off the 236. And this for me was a very significant thing. So I was thinking like, okay, if it goes up now, that could really mean something, because of the times that I have been trading, since the time I have been trading, when price bounced back off the 236, in all cases, I've seen a really significant rise in price. So this was for me a very important moment. And as it happened, it did happen that price breached through the key level. And judging from the momentum at that time that was going on, I decided to get in with a market buy. I don't remember exactly the entry. I think it was somewhere around here or here. And it was a good call, because what happened was price totally exploded upwards. And that was amazing trade. And basically the next thing that I would do is repeat the process again. So we've made a higher high, but we have never made a lower low, essentially establishing or maintaining the current trend. And you could even go as far as to say, like, okay, here we are finding now support. And if you draw that back, it is essentially a support and resistance flip from here. So with that knowledge, just purely based on market structure, there's for me absolutely no reason to go out of my trade, as there has no lower low has been printed, and we continue to keep on making higher highs. And as the price moves on, it gave me a really good case to let my winner run, basically. Personally, I was monitoring. This one. This one for me was a little bit less significant, because I thought, I found it of less importance, which was a good choice, because I can remember we did breach through it here for some time, but then we basically kept moving up, and eventually it basically brought us to where we are now. If I can find it back here, it brought us basically all the way up to 8.4k, and was very, and that's the power of market structure that I find very, very, very nice to use. And based on this market structure, you can really go from a high time frame to a low time frame. And in regards to the support and resistance level, it is essentially the same thing as what I did on the 5-minute time frame. You can also do it on the yearly time frame or the monthly time frame. You could say, like, okay, if we pull it from the closest, then this would have been a high. And because in the group we label them as monthly, weekly, and dailies, I also have like a template set up for that. So let's say this is a monthly level. This was a high. And we came back onto the low. So those are key levels of a monthly trend. And as you can see, very strictly speaking, we have never been in a monthly uptrend. Although it's arguably, you could argue that there was some sort of a monthly trend on the moment when we've breached this level here, because we had been consolidating for a good couple of months, nearly 6-7 months. So there is a case to be made from this point on that the monthly trend was broken. But if you're really strict on technical analysis, we have never been in a monthly uptrend. With a weekly uptrend, it's slightly different, because we had here a weekly. So let's say you're monitoring the price basically from here. Then you could make the case that this was our last high, or this was our last high. It depends on the amount of data you have available. You could say that, okay, we made here a low, a weekly low. And then what happened next was we made a new high. We made a new high. And what happened afterwards, we made a higher low. And that's also the point where this level is less relevant to me, because we have made a higher low. So this is now the more important key level on the closes. Actually, arguably, this is the most important one, because this is the last high point before the low was in. But for the sake of recent price action, I like to choose the more recent price action of picking those horizontals. And as you can see, low, high, lower low, and at this point on, that's when we made a higher high. So this was the confirmation that we are now in a weekly uptrend. And basically you can go all the way down to the daily, to the 1 minute, even to the 1 second time frame. So yeah, that's basically what I kind of wanted to cover. In combination with putting these horizontal resistance lines on the candle closes and pulling Fibonacci from the wicks, like I said before, is generating a very nice mixture of additional confluence. And in order to add more confluence, and especially on low time frames, I also look at different things like volume, points of control, EMAs, to get a sense of momentum. But bottom line of this video for me is being able to identify the market structure. It also paves the way to analyze these structures within those structures by applying other tools such as Elliott waves and harmonics and so on. So for me, this really is the base upon which you can build the rest of all your other analysis. But that breaches a bit through the scope of what I wanted to go over in this video, and has to be left for another time. I hope this provided some insights, and with that I would like to end this video. I hope you enjoyed, and see you next time. Cheers!